Some Canadian hedge funds are finding their growth crimped by tougher sales policies of the country's second largest bank. Toronto-Dominion Bank has put a limit on how much its retail clients collectively can own of particular funds, according to people familiar with the matter, to de-implement the rules and partly to mitigate the risks associated with being too exposed to any one firm. The people said hedge fund providers, Toronto Investment Management, and Polar Asset Management Partners are among those caught in the net, said the people. The funds are victims of their own success. Their individual investors are eager to own them, but Toronto-Dominion has restricted sales in order to cap total client holdings, said the people, who asked not to be identified discussing confidential policies. The additional scrutiny came on the heels of the collapse of private credit firm Bridging Finance Inc. in 2021 and regulatory changes in Canada known as client-focused reforms that were implemented less than 2 years ago. The new regulations tighten the rules governing investment advisors and the disclosures they must make about investment products they sell. Toronto-Dominion introduced standard criteria for due diligence and concentration limits on alternative investment funds, which include hedge funds and private asset funds, said a person familiar with the bank's policy. We regularly review our products based on many factors such as risk assessments and the regulatory environment balanced against being able to offer our clients robust investment choices that meet their needs. Julie Bellissimo, a spokesperson for Toronto-Dominion, said in an emailed statement. Canada's largest banks have secured dominant positions in the investment advice business, consolidating it as firms like Merrill Lynch exited the country with their large networks of advisors. The banks has played a key role in deciding which new hedge funds and mutual funds have the best chance to succeed and grow. TD has more than 800 investment advisors in its Canadian wealth management operation. Its combined wealth and insurance unit earned $2.4 billion. During the fiscal year that ended October, $1.8 billion. Some Canadian advisors and their clients were burned when Bridging, a Toronto private credit firm run by a husband and wife team, David Sharp and Natasha Sharp, failed 2 years ago. Bridging had about $2 billion in assets under management when it was put into receivership, with regulators alleging that senior executives mismanaged funds and failed to disclose conflicts of interest. PricewaterhouseCoopers estimated last year investors will lose at least $1.2 billion under a proposal to liquidate the assets. That process is still ongoing. Tamilo, founded by veteran fund manager Jean-Francois Tardif, manages more than $500 million in assets, including the Tamilo Strategic Opportunities Fund, a long-short equity and bond strategy that has returned 19.6% a year over the past 3 years, according to the firm's website. Its JFT Strategies Fund, a closed-end fund that's listed in Canada, has returned 9.4% annualized since it was launched in 2012. Polar's flagship fund, which is $5.4 billion in assets, gained 1.4% last year, marking its 11th straight year of gains. The fund, managed by Chief Investment Officer Paul Sabrin, follows several strategies, including convertible arbitrage, equities, long-short trades, and structured credit. According to its website, Sabrin's fund has outperformed both the U.S. and Canadian equity benchmarks since fund's launch in 1991. And Time in Poland in reply to requests for comments.